Okay, so you pay car insurance every month. Let's say $100. You do that for years. Then one day you crash your car. The insurance company writes you a check for $15,000. And you think, wait, how does this work? I paid them maybe 5,000 total. They just gave me 15. Where'd that money come from? And if they're doing this for everyone, how are they not bankrupt? Because here's the thing. You're not the only one paying premiums. There are millions of people sending in $100 a month, and most of them never crash their cars. Most of them never file a claim at all. So the insurance company is collecting all this money from everyone, but they're only paying out to a few people. And somehow that math works in their favor, but it still feels like a scam, like they're just gambling. Or worse, like they're planning to deny your claim when it actually matters. But that's not really what's happening. Insurance isn't a scam. It's more like a very calculated bet. And the house always wins. Not because they're cheating, but because they've done the math. And once you see how that math actually works, the whole thing stops feeling mysterious. So let's follow your $100. You send it in, it goes into this massive pool. Think of it like a giant bucket. Your $100 goes in, so does everyone else's. The insurance company now has this enormous pile of money, and they know statistically how much of it they'll need to pay out. They've studied millions of drivers. They know how often people crash. They know how much crashes cost. They know that out of every 1,000 people paying premiums, maybe 10 will file a claim this year, maybe 20, but not all 1,000, not even close. So they price the premiums to cover those payouts, plus a little extra. If they expect to pay out $80 per person on average, they charge you $100. That $20 difference, that's their profit margin. But here's the key. The average is doing all the work. Some people cost them way more than $100. You, when you crash, cost them $15,000. But most people cost them zero. The ones who never file a claim subsidize the ones who do. You're all throwing money into the bucket. Only a few are taking money out. But here's the weird part. Insurance companies don't actually need to make money on the claims themselves. A lot of them don't. They pay out more in claims than they collect in premiums, and they're still wildly profitable. How? Because of what happens to the money while it's sitting in the bucket. You pay your premium in January, maybe you file a claim in June, maybe you never file one at all, but either way, the insurance company has your money for months, sometimes years, and they don't just let it sit there, they invest it. They buy bonds, they buy stocks, they put it in real estate, they lend it out, and all of that generates returns. So even if they're paying out more in claims than they collect in premiums, the investment income makes up the difference, and then some. This is called the float. It's the money they hold before they have to pay it out, and it's one of the biggest reasons insurance is so profitable. They're basically running a bank with your premiums. Now, this is where it gets interesting. Insurance works because of two things, scale and timing. Scale first. If you're just one person trying to self-insure, you're screwed. You either crash and can't afford it, or you don't crash and you saved a bunch of money for nothing. It's a coin flip. But if you're an insurance company covering 1 million people, it's not a coin flip anymore. It's predictable. Some people will crash, most won't. The outcome averages out. The randomness disappears. That's the magic of large numbers. Individual risk is chaotic. Group risk is stable. And timing matters because claims don't all happen at once. People crash their cars throughout the year. Houses burn down sporadically. Medical emergencies are random. The insurance company isn't hit with 1 million claims on the same day. The payouts are spread out, so they're always collecting premiums from everyone while only paying out to a few people at a time. The money keeps flowing in, the money trickles out, the pool stays full. But here's what people get wrong. They think insurance companies make money by denying claims. And sure, sometimes they do deny claims. If you didn't pay your premium, or you lied on your application, or the damage isn't covered, they'll say no. But that's not the main profit driver. The main profit comes from the fact that most people just don't file claims. You pay for 10 years and never crash. That's free money for them. You're not ripping them off. They're not ripping you off. You're buying peace of mind. You're paying to not worry about a $15,000 surprise, and most of the time you never need it. So here's the actual answer. Insurance companies make money because they're playing a fundamentally different game than you are. You're trying to protect yourself from a rare, expensive disaster. They're pooling risk across millions of people and betting on the average. They know most people won't crash, most people won't get sick, most people won't die this year. So they collect premiums from everyone, pay claims to the unlucky few, invest the rest, and keep the difference. The math works because the losses are rare and the pool is huge. You're not buying a service where you get your money back. You're buying protection. You're buying certainty. You're paying so that if the worst happens, you're covered. And most of the time, the worst doesn't happen. That's not a scam. That's literally how it's supposed to work. The system depends on most people never using it. If everyone filed claims, the whole thing would collapse, but they don't. And that's why it works. The many pay for the few. The house wins on average, and you sleep a little better at night.